Business and Compounding. This is Sandeep, Anand. Today's session, I'm going to explain the importance of understanding what debt means and how companies raise debt to finance, multiple things. A business definitely need capital to grow, and they raise it through two means. One is through the debt channel, like bonds and other things, and the other channel is equity channel, which is in the capital markets. This session is focused on debt. Debt is an important factor which helps us gauge the health of a balance sheet or the health of a firm with respect to how much percentage of debt the company holds. Let's get into some more details. Double clicking on the debt factors. There are two ways, as I said, to raise the debt. Debt financing allows a company to raise capital for expansion. It to finance the increasing capacity needs, working capital financing, and multiple other needs from operation standpoint. Debt is raised by the companies for repayment at an interest rate, which is also an important part of the cost of capital calculation, because the interest which the company pays is an important determinant of the cost of capital, and cost of capital is a significant factor in determining the future valuation of a firm. Debt financing is done by the firm when it sells fixed income products such as bonds, bills, or notes to investors, and they obtain the capital needed to grow or expand its operations. Debt financing is also done by taking loans from banks directly and other financial institutions for a fixed or variable interest. Interest, when I say, it's interest rates. So debt should be balanced for a firm, because to continue operations without sinking when the economy conditions turns bad, it's important to have a debt level which is balanced and which could be controlled. Most common reasons the companies go belly up or bankrupt is due to huge amounts of debt in the balance sheet, which they end up being unable to pay back, and they file for bankruptcy. A factor to gauge the health of balance sheet, as I said, and it helps us assess the debt level, how much company owes. So assets are what the company owns, and the debt level is what the company owes. And a ratio which is very useful in understanding how much debt is ideal, although not a sacrosanct number, is debt to equity ratio. Debt to equity ratio, typically you get it by dividing the total debt or liabilities of the company over the shareholders fund or equity. An ideal range could be like 0.5 to 1, or debt to equity ratio of 0.5 to 1, based on the repayment capabilities, earning potential, and all. It can vary. Now there is another factor called interest coverage ratio, which we will cover in another session. So the interest coverage ratio will help us assess whether how the company is placed to pay back the debt based on the future earnings potential and repayment capabilities. So that is a session on debt and how much importance it plays in the balance sheet. Hope you found this informative.